What's up, future CPAs? Welcome to a special LECPA prep session, where we're going to tackle a topic that often separates the prepared from the, well, unprepared. Inventory write-downs. Trust me, you want to get this right.
Okay, so here's our game plan to absolutely master this for your board exam. We'll cover what a write-down is, get into the huge difference between IFRS and GAAP, talk about reversals, see it all in action with journal entries, and finish with a rapid-fire review. Let's do this. All right, first things first, let's get to the bottom of the problem we're actually trying to solve here.
I mean, think about it. This happens all the time. A company's sitting on a warehouse full of last year's smartphones, and then bam, the new model drops. Suddenly, that older inventory isn't so hot. This isn't just a business problem, you know. It's a full-on accounting problem, and it has a very specific set of rules you have to know.
So this brings us to one of the most important rules in the book. It prevents companies from looking richer on paper than they actually are. You just can't pretend your assets are worth more than you can get for them. The rule is simple. You value your inventory at what you paid for it or what you can sell it for, whichever one is lower. And that leads us to this absolute superstar term you need to master, Net Realizable Value, or NRV. Just think of it like this. It's what you can realistically get for your stuff. It's not the sticker price, it's the selling price minus all the extra costs you have to pay just to get it sold. It's the real take-home value. Okay. Now let's get to the part that trips up so many students. This is where we get a major plot twist. What happens after a write-down? Well, it completely depends on which accounting standard you're following.
This slide right here is probably the most important difference you need to burn into your memory for the LSCPA. For us here in the Philippines, we follow IFRS, and that means reversals are mandatory. If that old inventory suddenly becomes valuable again, you have to reverse the write-down. Under US GAAP, no way. Once it's down, it stays down.
And what's really interesting here is how this table just lays out the whole battlefield. For your exam, you live in that IFRS column. Notice it says reversals are not just allowed, they are required. This is huge. It means our financial statements are designed to reflect what's actually happening in the market right now.
This quote pretty much says it all. It perfectly sums up the two different mindsets. IFRS is all about showing the current economic reality. You know, what's it worth today? But GAAP is all about being super cautious and conservative. It's like, nope, we're not counting that gain until the money is in the bank.
All right, let's focus on the main event, mastering the IFRS reversal rule. This is what you're going to use in your career, and more importantly, what's going to get you points on the exam. So, follow these steps and you're golden. You check the value every year, you see clear proof that it went up, you figure out by how much, and then you hit step 4. This is so crucial. There's a limit. The reversal can only bring the value back up to what you originally paid for it. That original cost is the absolute ceiling. And then step 5, you record the entry, which directly helps your profit.
So, let's talk impact. A write-down increases your cost of goods sold and crushes your profit. But a reversal? It does the exact opposite. It's like an undo button that lowers your COGS and gives your profit a nice little boost.
Enough with the theory, right? Let's get our hands dirty and see exactly how this looks in your general journal.
This is your move when NRV drops below past. It's pretty straightforward. You're increasing an expense, cost of goods sold, and decreasing an asset, inventory. And by the way, this entry, it's the same under both IFRS and GAAP. No tricks here.
But this is your moneymaker entry. This is the one that's a big no-no under US GAAP. You debit inventory to pump its value back up, and you credit COGS. That credit reduces your expenses, which means cha-ching, higher profit.
Okay, let's run through a quick example. Picture a tech company with a huge $200 million stock of older smartphones.
So in year 1, demand just tanks. They have to recognize a $50 million loss and write that inventory down to its new, lower value of $150 million. Ouch. But then, in year 2, something wild happens. Those old phones become retro, they're cool again, the value shoots back up, and a new assessment shows the NRV is now $180 million.
So what do? The value recovered by $30 million. Under our IFRS rules here in the Philippines, how are you going to account for that recovery? Think about it.
And there it is. You debit inventory for $30 million, bringing the asset's value back up, and you credit cost of goods sold for $30 million, which immediately cuts your expenses. This gives their income a $30 million boost that would be totally invisible if they were using US GAAP. Crazy, right?
Okay, let's move to the final and maybe most important part. If you remember one thing from this whole explainer, please, make it this next slide.
This is your cheat sheet. Seriously, screenshot this, write it down, do whatever you gotta do. Review this before your exam. It has everything: the core rule, the journal entries, the reversal limit. If you can explain every single one of these points, you have absolutely mastered this topic.
So, as you're studying, here's my challenge to you. Don't just memorize this stuff. Think about why the rules are what they are. Understanding the logic, that's what will help you analyze any weird problem an examiner throws at you. That's what's going to make you a great CPA. You've totally got this. Good luck.